class is sponsored by CMS Trader, one of the world's leading Forex and CFD providers. Now, CMF Trader is a regulated provider, so I'm therefore required to give you a risk warning. So let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, if you like, while we're in class tonight, if you go to www.cmstrader.com and just click on the buy or the sell button, you can open a demo account in about 2 seconds. There's no credit card deposit required. And you just pick a username and a password, and you can start using the charts on their trading platform to follow along and see the chart patterns that we talk about in class. Now, if you open an account with CMS Trader, you get some of the best education and tools available because they believe in investing in their traders. You also have many different types of accounts to select from. You get free daily signals. You have unlimited access to all their trading platforms. You get free daily market updates and technical analysis, and you get super fast execution speeds. So tonight we're going to be talking about patterns that appear on charts. And this falls in the realm of technical analysis. Now, in case you wish to watch or learn or go through this video again, this class again, it will be recorded and will be available in about 24 hours by going to investing.com where you enrolled in the webinar. Look under the education tab and then locate webinars on demand, and you will be able to see tonight's class. But it takes about 24 hours for it to get up there. Okay. But then you can also go there and see all of our classes that we've given over the years. Now, technical analysis refers to the study of financial markets based on price movement. It uses the assumption that the price of an asset reflects all information about that asset, including market sentiment, as well as perceived value. Charting refers to technical analysis that is performed through careful inspection of price data for identification of well-known patterns that emerge in share prices. For example, head and shoulders, channels, triangles, and wedges. Now, most people, when you mention the word technical analysis, they immediately think about indicators. And they don't understand this field of technical analysis is a very large field. Okay, it covers everything and anything that is done on or with a chart. So indicators and oscillators are mostly placed below the chart. Few are placed on the price chart or price action, but chart patterns that develop on the price chart are also another part of technical analysis. Just like being able to read candlestick patterns or reading a bar chart on a chart is still technical analysis. Anything that is done on this chart falls under the field of technical analysis. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. In other words, it's the buyers and sellers, or the bulls and the bears, that their reaction to the markets forms certain patterns that can be seen on a chart. Pattern formations do not form a trading system, but rather provide an indication of future trends of the price as it breaks key psychological levels in the form of support and resistance lines. Now, there are many different types of patterns, and they're all named according to the price graphs formed between the support and resistance lines. Now, the most popular are known as triangles, channels, wedges, head and shoulders, pennants, and flags. Excuse me. There are also all kinds of weird ones out there that individuals have made up because in this market, you have lots of strategists or lots of gurus pushing their own thing. I've seen all kinds of these patterns. A popular one is called teacup. Okay. There's orbs. There's all kinds of ones that some certain guru came up with. And maybe they work, maybe they don't. But the markets on the whole look at triangles, head and shoulders patterns, pennants and flags, bullish engulfing signals, bearish engulfing. The reason these are so popular is because they work well. And so the markets respect them. Now, the most common is called a triangle. That's not complicated. Now we have symmetrical triangles, ascending triangles, and descending triangles. Also, that's not complicated. An ascending triangle, you can see the support line on an upward angle, and you see the resistance line on a horizontal angle. A descending triangle is the exact opposite. So it's all based, the terms are all based on the edge or the direction of the support and resistance lines. And then, of course, we have the symmetrical triangle where we have both the support and resistance lines moving towards each other. But they're all called triangles. Personally, I don't ever say ascending triangle, descending triangle, symmetric. I look at them and say, oh, there's a triangle. Because basically, they all tell you the same thing. A triangle is formed between converging support and resistance lines. See, these two lines are converging together. A negative sloping resistance line indicates reducing level of profit taking or more uncertainty about the value of an asset. Okay. With a positive sloping support line, the price levels are squeezed into a corner, and this is the ultimate story about triangles. The buying and selling demand are getting pushed into or squeezed into the corner. At some given point, the pressure is built up and they are going to break out of that triangle. So once the support or resistance line is broken, pressure that is built up as a result of the uncertainty is released and a certain amount of momentum is added to the price change in the direction of the breakout. So none of these tell you that the breakout is going to be up or down. You don't know where that breakout is going to be until it actually occurs. Now, the funny part, or the nice part, is there are standard calculations to calculate the momentum that the breakout, when it breaks out, how far it should take you. So if you're going to trade on that breakout, you can guesstimate based on the formula exactly how far that momentum will go. So you can determine or estimate what your profit should be on that breakout. And that has to do with the width of these support and resistance lines. And we'll come to these formulas in a second. They're not very complicated. And they are accepted around the world. So they're not unique. I'm not giving you some Barry Norman secret. We're going to be looking at what has been tested around the world and accepted by the trading markets. Now, there are specific variations of triangles that can occur, namely ascending and descending triangles. An ascending triangle has a horizontal resistance line, which we have here, and a horizontal support line. An ascending triangle usually occurs in the continuation of a bullish trend, but it can appear in a bearish trend. But on the whole, this is what you'll see because price is moving upward and you have your support and resistance line. But it doesn't have to be that way, and it doesn't change the rules. A descending triangle, it usually occurs in a downtrend, and your trend line is drawn over the top of the prices, which is the support line, and the resistance line, because price is trying to break through this line here, this level here, and that's resisting it, is a horizontal line. And this is what forms the descending triangle. Now, the other thing is they don't have to be completely 90 degrees or 60 degrees. It's only that the two lines are converging together to show pent-up demand in the trading. Buyers and sellers together are being forced into this corner. Now, it's important to note that an ascending triangle can also be found in a downtrend. So the combination of the name of the triangle and the market trend is kind of deceiving, but don't worry about it. Thus, the financial asset needs to test the resistance level twice, and the asset's closing price needs to be higher than the previous closing price. In other words, the closing price has to follow the rising trend line. That's it. It must stay on that trend line and within that triangle. Now, the key here in any of these triangles is volume. Volume tells you when we're about to have a breakout. When in an ascending triangle, volume contracts, although there are a few number of cases that shows volume has not contracted, but the pattern has been displayed. This may signify by the blue line at the bottom of your chart. You know, we're going to look in a second, but you all know how to put volume on your charts. So the distance between the rising trend line and the resistance line, because if price is moving up, this is the support line or the trend line. This is the resistance line that price is trying to go above, has a mathematical calculation. So if our resistance level had a value of 1, and the start of our trend line had a value of 0.5, then our upward projected value would be 1.5. So in other words, if price broke out on an upward motion, we would expect it to move 1.5 or whatever. Now, that's not a multiplication factor. It's really just a difference in the price of the asset on the chart that you're looking at. So if the euro was at 121.50, and here it was at 122.50, 123, that would be a variable at 150. So when it broke out, we would expect it to break out that same variable different distance, or the difference between the upward movement. But we'll see the formulas in a second, and they're not all that complicated. Now, we're going to come to all different types of patterns. Channels and rectangles. We're going to look at wedges. And to me, I don't differentiate in what they're called. Okay, they're simply support and resistance lines. A channel is formed. Let me go back. A channel is formed when by parallel support and resistance lines. This pattern usually indicates a relatively strong trend with the price staying within the lines until a breakout. A breakout from the channel indicates either a reversal in the trend or a change in the slope of the direction. A rectangle is basically the same thing, except we have horizontal support and resistance lines. So similar to a channel, a rectangle is a pattern formed between horizontal support and resistance lines. Rectangles and channels, though, are important to remember, but you'll remember them more by names that are more commonly used. And they're sometimes referred to as flags and pennants. So a flag would be defined as a bullish continuation channel down, or a bearish continuation channel up. A pennant would be defined as a bullish continuation triangle or a bearish continuation triangle. Now, wedges are the same as channels or rectangles, except the support and resistance lines are moving in the same upward or downward direction, but they are converging on one another. Wedges are similar to triangles in that these patterns are formed between converging support and resistance lines. However, where the support and resistance lines in a triangle have one positive and one negative slope, the support and resistance lines of a wedge have both either a positive or a negative slope. Wedges with positive slopes are called rising wedges, and wedges with negative slopes are called falling wedges. Okay. Again, you don't have to remember all these names. I mean, they're easy to remember, but you'll see them on the chart. You'll look at them and you say, oh, it looks like a triangle, but it hasn't come together. Well, then you know it's a wedge, but the explanations don't vary. Okay, so if you call it a triangle instead of a wedge, it still has the same outcome. The most common wedges are found as breakouts in the opposite direction of the wedge. That is, bearish breakouts in a rising wedge and bullish breakouts in a falling wedge. So in other words, when we get a wedge in an uptrend, most likely it's going to break out downward because it's going to develop during the end of the trend. During a falling wedge, it's usually developed during a downtrend, and when that wedge is fully formed, it tells us we're going to break out in the opposite direction or form the opposite trend. Now, one of the most popular and one of the most reliable signals is called the head and shoulders. Now, a head and shoulders is kind of hard to recognize. It's not very difficult, but it takes a lot of lines, and they're not straight lines, to see these. But when they develop, and they don't develop very, very quickly, so you have ample time to see them and see the development. But when they do develop, they are very reliable. Now, I'm not going to explain the opposite. We have a head and shoulders, and then we have an inverse head and shoulders. One develops during up movement, one develops during a downward movement. These rules are all exactly the same. They just flip over. So a head and shoulders pattern describes a price movement that picks the head and the shoulders of a person. Not complicated, is it? It's just what it is. The head and shoulders is a reversal pattern from a bullish trend to a bearish trend. The pattern starts when the price graph crosses the support line upward before the formation of the left shoulder. So in other words, we would have a support line here. We would be in an uptrend, and the price would break above that support line. It would come up to some given point and then fall back down, not far, but retrace back down to some degree. It would then bounce back up, and that bounce would be higher than the previous bounce. And the reason we have this then is called a head and shoulders, because this forms, and which you wouldn't know, and you wouldn't even know at this point, has formed your left shoulder. And when it bounces, comes back down and retraces, okay, now what you have is a head. So you have a left shoulder and a head. But one of the key rules is when it bounces down, it must equal the level of the prior fall, because this develops what we call the neckline. So you have to, so if this shoulder started the formation here, came down here, then the head bounced back up, and then came back down to here and then bounced back up, you wouldn't have a head and shoulders pattern. You must have the formation of this neckline here. Because again, imagine as a person. Here you have your left shoulder here. You have your neckline here. You have your head developing, you have your head, and then you have your right shoulder, and that's your neckline at the same level of your left shoulder. Now, they don't have to be 100% exact, especially in Forex market, because we're moving in tiny little pips, but they have to be pretty close. So imagine this is like a human being. You have two shoulders and a head. You can have a long neck, a short neck. You could be a little bit lopsided with one shoulder higher than the other, but not much. So imagine it's in the same idea of what a person would look like. Now, when you have the double bottom here that occurs on the neckline and bounces back up, at this point, it would be forming the right-hand shoulder. When it retraces, that shoulder must be fairly equal to the left shoulder. Again, you can have somebody who's a wee little bit lopsided, but it can't be way out of proportion because, again, you don't have a head and shoulders. We only need to notice it when we're somewhere about here because there's nothing we can do. First of all, we wouldn't notice it here, and there's nothing we can do because until it makes this neckline, and then until it forms the right shoulder, it's only possibly. So we wouldn't want to prepare. We wouldn't want to be doing a trade. We wouldn't want to be doing anything until we see the formation of the right shoulder. The pattern starts when the price graph crosses the support line upward before the formation of the left shoulder and is completed once the graph crosses the support line downward after the formation of the right shoulder. So this would be the official completion of the pattern. Okay. Now, when we have this pattern completion, it tells us something. The popular head and shoulders pattern is essentially a triple top pattern, except that instead of all the peaks hitting the same resistance level, the head peaks slightly higher than the shoulders. Now, some investors, and you'll read all kinds of strategies, have all these types of equations where the head has to be so much percentage higher than the shoulder, and the shoulders have to. These are all individual gurus out there preaching their own thing. Okay. Now, some investors have specific beliefs that the amount of the bearish fallback that should occur between the tops, with some allowing for a 10% loss before the return to test the resistance level, and some requiring at least 15%. Regardless of the opposing views, these patterns are very popular among traders and analysts as they predict trend reversal. So when we would see this head and shoulders pattern developing when we were in an upward moving trend. So the price would be moving up here, would come to the next resistance line breakthrough and continue moving up. So we have an uptrend. When this develops and we get the right-hand shoulder and it falls back down, that tells us that the trend is over. So signal strength is bolstered by the agreement with other indicators, such as waning volume as the trend nears exhaustion. And an inverse head and shoulder appears as the completion of a downtrend, where the head and shoulders is the completion of an uptrend. So an inverse head and shoulders is similar in the shape, except that it's an upside down and indicates reversals from bearish to bullish trends. Now, let's talk about how we can use these in our trading. Head and shoulders indicates both the end of a trend and the possible change in the direction of an asset. And there's a very simple formula that we would use. The given pattern is formed in an uptrend representing 3 peaks of the market price arranged at different levels. The pattern's lows are connected by support levels called the neckline. And the neckline is crucially important for our calculation here. If the price falls below the neckline or support line, a sell signal arises. So on this chart, you can actually see in reality, they're a little bit not as clear as we saw in our little sketch before. This is in reality, but it still forms the same thing. It's not as pretty as what we saw over here, but this is what we would see in reality. So if you understand the rules, This still fits the same rules. It formed the neckline, went up and formed the left shoulder, came down, formed the head, came down to the same neckline, and that's why the neckline is crucially important. Came up and formed the right shoulder. And as you can see here, the right shoulder is slightly higher than the left shoulder. So that means maybe the person's leaning over, maybe the person's got a slight limp, okay? And then the price fell back down to the neckline and broke the neckline. That, when it breaks that neckline, that generates a sell signal. Now, in order to see if it's a tradable signal, and how far that price should go. If you're selling, you're betting on that asset to fall. We would use a standard calculation. It is T. Your target price of where you would set that trade to go is equal to the neckline minus the head minus the neck. So if we give some values to this chart here, and we say that the neckline, because you're using the real numbers that are on a chart. But in this case, we're saying the neckline is at 1. And we can say the head is at 3. So we would take our target price would be our neckline, which is a 1, minus the head, which was a 3, minus the neckline, which is a 1. And we end up with the target is 1 minus 3 minus 1, 1 minus 2, or a -1. And this would be about a -1 if I did my math correctly. Okay, and this is where you would set your target, so you have your buy level, you have your take profit level, you would set your stop loss at the highest of the shoulders, okay, and this would help you enter a trade. Give me 1 second here. Now, this is a simple calculation. Okay. I don't know why this is so complicated. This is a sell signal. What is a sell signal? You would short, because when you get a head and shoulders, it's telling you it's the end of the uptrend and beginning into a downtrend. When it forms the the right shoulder and breaks the neckline, it is telling you to short the asset. It is an inverse head and shoulders, it's the same calculations, but it's a buy signal. Okay, we've gone over this several times already. Okay. A multiple top chart pattern. A multiple top chart pattern occurs in an ongoing uptrend. It indicates the trend is nearing exhaustion. Now, we have multiple tops and multiple bottoms. We have simple double tops and double bottoms. I don't put any value at all because double bottoms and double tops occur a billion times a day in all price movement. Because all that means is the price fell to a support line or a resistance line, bounced off it, moved back up, and twice hitting at that support line isn't enough to make you do anything, because statistically it happens over and over and over again. So double tops and double bottoms are reversal patterns that touch either the support or resistance level twice before reversing the trend. Look for a strong initial trend and a significant breakout in order to confirm the reversal. And like I said, this happens so often. You spent your life trying to look at double tops and double bottoms. You'd overlook the whole rest of the market. But again, it's got a simple formula here to set your buy and sell and your target prices. But I would not ever consider trading from a double top or double bottom. But when we come to triple tops and triple bottoms, then we start to get more validity. If you just think about it, when price is moving up and down and bouncing between the support and resistance lines, 2 times can be just a statistical anomaly. But if it does it 3 times, you've got to pay attention. Triple tops and triple bottoms are reversal patterns that touch either the support or resistance line 3 times before reversing their trend. This is a stronger indicator of a trend change than a double top or double bottom. Look for a strong initial trend and a significant breakout in order to confirm the reversal. And pay very close attention to volume and use an additional technical analysis tool such as RSI or stochastics. Okay. Or MACD will also help you extremely well in these situations. Now, triple top is a price pattern which is formed in an uptrend. So again, price is moving up, comes up to a support line, a support level, and this support level is a support level that you've already drawn on your charts, nothing to do with this price, and moves up to the resistance level that you have on your charts. Price falls back down and comes back to the support and bounces off that support level, moves back to the resistance level again, falls back down to the support level. Okay, once it breaks that support level after forming the triple top, what you know is price had been moving up steadily in an uptrend. It has lost the momentum to break through that top, and it has tried 3 times to get through. By the time it's hit that price 3 times, most of the people in the market that had bought into the market are saying, uh-oh, it's time for me to get out because it's not going to break through that level. So I'm getting out of the market. Also, sellers are looking and saying, you know what? Okay, that resistance is very, very strong. It's time for me to sell into that market. Okay. Now, this isn't for you. You want to wait till it comes down here and hits the support level and is unable to bounce off of it again. When it breaks that support level, okay, it's telling you that this uptrend is definitely over and generates a sell signal for you. Okay. We can calculate our target price. Number one, we put our stop loss at the top, at the resistance level, and we would enter right below the support level, and we would set our target price for a simple calculation. Target price is equal to S minus H, which is the support line minus the height between the support line and the resistance line. Okay. If it's a triple bottom, it is again simply the reverse. Okay. Now, once again, these calculations are not mine. These aren't I'm not playing the guru here and telling you what to do. These are standard acceptable market calculations. Okay. So what I'm saying is these are everybody's. This is not a Barry Norman strategy that I'm telling you, I'm departing some great secret to you. Okay. You don't want to trade from secrets. You want to trade from what is long tested in the markets. Okay. A triple bottom is the exact opposite of the triple top. Now, what is always important when you're looking at chart patterns is to verify the quality of the pattern. How do we do that? Okay, we do that by looking at the trend action. Okay, because we have triple bottoms and triple tops that happen in an uptrend or a downtrend. We have ascending and descending or symmetrical triangles that happen in trends. If the quality of the trend and is a very good trend, then the quality of the signal from the pattern is very good. But see, you can have weak trends. You can have price movement moving upward, but you don't have a well-defined trend where price is moving all over the place and bouncing up and down everywhere. It could still be increasing, but you don't have a quality of a trend. A trend should move in a push, and an ease, a push and an ease, push and an ease. And each one of these lows should be a higher low than the previous low. And if you don't understand how to determine trends and the quality of a trend, you should come to our class and the trend is your friend. Because price doesn't move in a straight direction. It'll move in a pattern moving up or a trend line. But every trend line has pushes and eaves or peaks and valleys. But those peaks and valleys have specific definitions. When you can determine a good quality initial trend, the pattern you're going to get from and the signal you're going to get from these patterns is much more valid, because you can get a triangle in a messy, messy, messy trend, but it means it's not going to be so reliable. Now, the pattern is said to have broken out once it has crossed either the support or resistance line. Now, when we're looking at, head and shoulders have definite breaks in a specific manner. Triple tops and triple bottoms have definite movements in specific manners. Whereas triangles, wedges, rectangles do not. You have the formation of these patterns, but none of them will tell you until it actually happens whether price is going to break up or break down. So what we want to do is we want to look at the formation of this pattern and be prepared for what happens. So when price breaks upward, when price breaks the rectangle, the wedge, the triangle, and is broken out, in other words, that pent-up demand is all pented up, and either the buyers or sellers have now taken control, it's called a breakout. Now, it can break up or down. So if the pattern broke out in the same direction as the preceding trend, it is called a continuation pattern. In other words, the price had been moving up, triangle formed as it got in the middle of that triangle. We're going to look at some of these on real live charts in a second. And then broke out of that triangle in the same direction of the trend. That is a continuation. That's telling us that that trend is going to continue. If it breaks out in the opposite direction, it's a reversal pattern telling us that trend is over. Okay, now we're looking at a standard chart of calculations. Okay, you can find these through the internet. Again, just go look for chart patterns. These are standardized. Again, these are not Barry Norman's predictions. Okay, and you can have all of these on your own computer, and this is how or where each one of these patterns, when you see them form, how you would define where your stop loss should be, how you would define where you enter the market, and how you would define the target price. And when you're trading, what do you need? You need the price to enter the market, the price to exit the market, and where to put your stop loss. So this makes it very easy to trade. But you remember, you need to have other pieces of information to verify the quality of the signal, primarily volume and a second indicator. So let's go over and look at some charts that I pulled up for us that have different patterns developing on them. Now, it's very rare that we have it so beautifully, but here we have an inverse head and shoulders. Okay, this is a current chart. Now, I am not giving you any trading recommendations. Okay, we're not here to talk about silver and what silver might do. We're here to see the pattern. Now, what we see is the formation of the right shoulder, the left shoulder, the move back up to support, the formation of the head, the move back up, the formation of the left shoulder. Now we've got the completion of the final shoulder, and now we would expect price to bounce up and continue upward. Okay. Now, we don't know what is happening now because this is a current chart. Okay. Now, this is a chart on a weekly basis, so this is a slow-moving process. So if you're day trading silver, it's not going to help you because we're looking at a very slow moving pattern. But you can see clearly the inverse head and shoulders. And you can see it's complicated to see it just on your charts. So you have to be able to tune your eyes to be able to see these patterns. Now, here we have a beautiful falling wedge. Okay. Price is trading within this wedge. It's still holding within the wedge. It's formed a new double bottom now. We're expecting price to move back up to the top of the wedge and hit the resistance level, come back down to the bottom of the wedge again, come back up, and we're hoping that it's going to break out in an upward movement. But we can't, at this point, we can only project, but we have no idea because we're still waiting for this finished pent-up demand as we move to the center of wedge. But it can break out at any point. It could break down, it could break out. But this is what we're looking at in the formation of the falling wedge. Here we have a beautiful triangle that formed in price. And look at that. We had price moving in a downtrend. It formed a triangle. It broke out. And which way did it break? It broke in the direction of the trend and therefore was a continuation pattern. And if we look at the difference between the height of the wedge here and here, and we look at the difference of the breakout, they are virtually the same. To follow the same calculation we had. Now, we also had other signals. We had volume. Look at where volume was as price was trading towards the center of that triangle. And then look what happened when we got the breakout. See, volume is here completely very, very low, like it's supposed to be as we're forming that triangle. We got the breakout and volume soared. We also had a divergence in our technical indicator because our technical indicator is forming higher highs while our price is forming lower lows. So again, it's combined with 3 different types of information. Let me just get my markers off of here. Okay, here we can see in the 1-hour chart on Bitcoin all the different patterns. We had a beautiful triangle formation here. We had a breakout in the direction of the trend. Look at that breakout, a lot of momentum. We had it then move into a wedge, break out from the wedge, continued way down because it broke out in the direction of the trend. And we can see all of these different formations on the charts. How we decipher them and how we interpret them takes a little bit of knowledge and practice and expertise. Again, here we have a beautiful wedge forming. And so we're looking at Bitcoin again, and 9,500 is a possible next target for a correction. Maybe a broken wedge could send Bitcoin higher. So if we see Bitcoin bounce off of here, bounce down to the resistance level, move back up to the support level, and break out of the wedge, we would expect it to move up to the next resistance level, which was 94.88. Okay. So the next move we're expecting is to come down and retest the 6,000 level and then move on up. But we still need a lot more information to make a trading decision, but we're preparing ourselves. So this is the different ways that you can use price patterns on charts. And the fact is, price patterns on charts, to me, are a lot better than using all the technical tools and analysis and technical indicators and oscillators, because all this is doing is interpreting actual price movement. There are no calculations. There's no all of these numeric algorithms and everything else. Now, we would use an indicator to confirm, but we're making decisions actually based on current price movements and what is happening on the chart at the moment. Now, there's a ton of information available to you on the internet. Chart patterns are well known and they're well standardized. So you can go in and go into Wikipedia, you can go into all over the internet. Now, again, don't find some guru that's trying to teach you how to trade teacups and all this weird stuff. Look for classes or look for articles that are strictly about the known patterns and how to recognize them and use them. Okay, and on that note, I'm going to say goodnight to everybody. Thank you very much for joining us, and go to www.cmstrader.com, set up a demo account, and they have a huge amount of education for you, and you'll be able to read and watch videos on all of the stuff we talked about tonight, and see videos on each one of these patterns. Now remember, you can come back tomorrow to investing.com and see a copy of tonight's class. Thank you very much for joining us, and have a great trading day. Bye now.